I think most investors would never believe that a dying company like AT&T could ever outperform the S&P 500. Well, this has been the case over the last 6 months. AT&T found a floor. It's up over 18.8%, excluding the 6.5% plus dividend, versus the S&P 500 of 7.3%. But AT&T is still trading much lower than where it should be trading at, in my opinion. This is a stock that I got bullish on recently. I talked about it in the last earnings report. I said I was extremely impressed with AT&T's numbers, and over this quarter, I'm going to show you my earnings analysis on AT&T, and I'm going to tell you about the dividend, which is 6.5%. I'm going to tell you why I see over a 10% upside potential annual on AT&T, maybe closer to 12%. I mean, this is pretty shocking because this is a dying company that we all hate. But I looked at it before it went up to 17, it was like $15. I'm like, this looks cheap. The dividend was 7.5%. Now it's 6.5%, and I still believe the company is cheap, and I still believe the dividend is safe. I'm going to share that all with you here in the video, but I just want to say something because I know I'm going to get comments saying, why would you talk about a dying company? Well, AT&T is not going to make you rich. I think most of you know that. And people that invest in AT&T in dividends, they're looking for stability and income. We're all looking for different things in the market. Some people want to be aggressive and they want the highest return possible. Some people want low risk but sustainable returns. And this is what AT&T provides. Now, in terms of the recent metrics, postpaid phone subscribers, they have been growing. It slowed down a little bit, but it's still pretty good numbers. AT&T fiber subscribers have been the fastest growing ones. Not much in terms of profits. So wireless one is still much more profitable, but fiber is growing and they're going to monetize it very well in the future, I believe. Now, in terms of free cash flow, which is my favorite one, cash from operations, or you could say free cash flow for the quarter, it still grew pretty well, and this is what I'm focused on because this company like AT&T needs the free cash flow to pay down the $110 billion of debt, and they need the free cash flow to sustain the dividend. And I believe they can do both, and I'm going to tell you how in the video. But one of the reasons why the market freaked out and the stock went down over 3% on earnings was mainly because they had to revise their guidance lower from, I believe, 241 to around 225 for 2024 in terms of adjusted EPS per share. This is due to a lot of depreciation and one-time expenses and all these kind of things. Now, for me personally, I am not too worried about that. I try to focus on the free cash flow with these companies that have high capex and stuff. So I'm looking at free cash flow, and free cash flow is expected to be $17 to $18 billion for 2024. And this is massive in my opinion. And it's the same thing with Verizon. This is why I was a little bit bullish on Verizon before, was because they are trying to reduce and slow down the capex spending. And this is key because once capex goes down, free cash flow is going to go up. And they can use the free cash flow to pay dividends, to pay down the debt, to buy back stocks. They can do a lot of things with the free cash flow. So in terms of free cash flow, I am extremely satisfied with the guidance from the company. I think the 3% down move was a little bit of an overreaction in my opinion. But this is again a company with a 6.5% dividend, but they are still growing wireless revenues 3%. They are still growing broadband revenues 7%. So I believe they did well on spinning off Warner Brothers Discovery. It hasn't been the best performing stock. I lost money on it in 2021, but I think they did well on it and it helped them reduce the debt. Now, most of you really care about the dividend because you believe the dividend is the main way you're going to get returns with AT&T. And I agree with you on that. But there's another way you could get some returns with it, and I'm going to tell you what it is. But in terms of the dividend, it's around 6.5%. It was all the way up to pretty close to 7.8%. I believe it also touched 8% for a little while. And now it's around 6.5%, which is still much higher than what you could get in money market funds or CDs, around 4.5% to 5%. So 6.5% is a good dividend. Now the question is it sustainable? In terms of free cash flow, it has been improving, as I said. It's around 17.3 billion for 2024. 2025, 17.7 billion expected. It's expected to drop to 15.8. But I'm just going to use the $17 billion free cash flow for 2024. Now, if we use $17 billion, the dividend is around $8.1 billion for 2023. They did lower the dividend whenever they spun off Warner Brothers Discovery. They made a dividend cut, and I believe this was the right thing to do. So $8.1 billion in terms of dividend paid. The free cash flow is pretty close to $18 billion. So this is around $10 billion of free cash flow left after paying the dividend. Now, in terms of $10 billion, this could do a lot for the debt that they have, because the company does have a lot of debt. The company has over $148 billion of net debt. This is massive, very massive amount of debt. And the $10 billion should be enough for the company to create massive value to shareholders by paying down the debt, because there's some maturities due around $7 billion, 8.9, 5.9, 8.6. So if the company has $9 to $10 billion of free cash flow left, they can easily pay down the debt repayments and still sustain the dividend. They might not be able to increase the dividend more than 1 to 2% annual, but they can sustain the dividend, and they can also do debt repayments, which could be massive for the company. The average interest rate is something close to 4.2%. Now, if they use the $10 billion and they pay debt every single year, 4.2%, this is around $420 million of interest savings every single year. If they do that for 10 years, this is $4.2 billion of interest savings, which could increase the free cash flow by more than 20, 30, 35%. Now they're paying over $6.7 billion of interest every single year. Now, I don't believe AT&T is going to pay off the whole debt, because this whole company pretty much runs on debt. This is why the business model is predictable. You tend to leverage up to increase, return on equity, and a lot of companies do that. Verizon does it. T-Mobile does it a little bit. T-Mobile has been performing amazingly well, and AT&T does it too. So I don't believe they're going to really pay off $10 billion every single year for 10 years. But I'm just giving you the math that if they use the leftover free cash flow, every $10 billion is going to save them around $420 million, which could increase the free cash flow. It could lead them to do buybacks or increase the dividends more in the future. So in terms of the return for AT&T, you have the 6.5% dividend. You have the around 3 to 3.5% revenue growth, which is around, I would say, around 9, 10% annual. Let's say 9% return from these two. But you also have the increase in free cash flow in the future from the debt being paid down as interest expense comes down. And in my opinion, that could be around 10, 11, maybe close to 12% annual if the company gets no multiple expansion. It's trading around the 14% free cash flow yield. Now, if interest rates go lower, then you could get a multiple expansion. It could trade around the 10% free cash flow yield again, which could be around the 13, 14% annual return, roughly, just using math, 13 to 14%. With the dividend and everything, and free cash flow growth and revenue growth, for a dying company like AT&T, which is why I'm going crazy over the stock, that yes, it just looks bad in a dying industry. Maybe it's a value trap, but to me, it doesn't look like it's a value trap. And even though it rallied a lot, over 18%, it still looks like a pretty decent buying opportunity, in my opinion. Now, one thing you have to pay attention to, they still have the lead cables kind of stuff. Some analysts, they expect $4 billion for AT&T to replace them. Some analysts expect like 800 million. Another one expected, I believe, 6.5 billion. So it's all over the place, and no one knows where it's going to end up. But it's likely going to be 2, 3, 4 billion, and the company has like 130 billion of net debt. So this was my opinion on AT&T. I don't think it's as bad as you believe. If you think about it, dying company, no one wants to touch it, but it's still not bad. Even though it rallied, the dividend is safe. You get a return from a potential multiple expansion. You get a return from low single-digit earnings growth or free cash flow growth. You get a boost in free cash flow as CapEx comes down and as interest expense comes down. So this is huge, and I'm a big fan. I don't own it, but I see a lot of potential with AT&T. And this was my video on it. It was not financial advice. I hope you enjoyed the video. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.